today's data surprised on the upside, but I think the focus from the BOJ would be more on the medium-term inflation. So it's highly unlikely they will make a move in this meeting. Most likely, the next move is going to be somewhere in the middle of the year when they might lift the yield curve control policy.
Suresh, translation in terms of positioning, and let's bring in Warren Buffett here. The fact that he is positioned and buying Japan from a foreign investor point of view, what is that telling you?
I think technically there is room for the Japanese banks to do well because we do expect yields to go higher in Japan, and that's going to be good for the banking sector as such. But for the overall market, we are a bit concerned because there's an inverse correlation between Japanese yen and the equity market performance. And we do see Japanese yen strengthening later in the year as BOJ lift the yield curve control policy. And that's going to be negative for the Japanese equity market. That's why we have an underweight call on Japan versus global equities.
Interesting. Suresh, what's the high watermark that you have penciled in? Because we've been hearing forecasts for dollar yen clustered around 120, 125 by year end. Are you looking at levels in that ballpark as well?
Yes, that's exactly our forecast. So we are looking at 125 in 3 months and 120 in the next 12 months. I think the move is going to come once BOJ decides on lifting the yield curve control policy, which might be during the middle of the year policy meeting.
Ex-Japan, Suresh, how are you positioning in Greater China markets?
So in Asia, we are solely focused on the Chinese equity market because we are in an environment where the global economy is slowing down. But China is the one economy where we are seeing a recovery taking place, especially as China is coming out of the COVID lockdown. So this year, we should see very strong earnings growth in China. We are looking at close to 17% EPS growth compared to negative EPS growth in the global equity market. And the valuations are not really expensive, especially after the pullback that we have seen over the last 1 or 2 months. So we think this is a great opportunity for investors to position their portfolio from the Western markets into the this part of the world, especially in China.
And broadly, in terms of the investment thesis, given the current context, is fixed income still the default proposition over equities?
Absolutely. I think this is a golden opportunity for income-oriented investors to build their bond portfolio. We have not seen this opportunity in the last 15 years since the GFC. This is the first time that yields are so high. And the yields are not going to stay here for a very long period of time. Come next year, Fed is likely to start cutting rates, and that will benefit the bond investors. So that's why we think this is a time to start building your bond portfolio for the next 5 years.
And just give us a sense of the flavour of how you are approaching ASEAN, Southeast Asia, Suresh, an environment where here in Singapore, the MAS recently surprised the market by not tightening the policy, but keeping policy on hold. That seemed to be getting a lead on possible recession and mitigating that risk.
So in ASEAN, we are focused more on the domestic economies. Those would be Indonesia and partly Thailand as well, which is going to benefit from the return of tourists from China. Singapore, we are a bit cautious because the property cooling measures are going to weigh on the property stocks. And at the same time, as the US interest rates peak, it's quite likely that there will be very limited upside on the banks in Singapore. The opportunity more would be in the Singapore REITs, which are yielding 5.5% to 6% kind of yield in Singapore dollar, which look very interesting from an income perspective.